Question 1. Upon reviewing the Oracle EBS R12 General Ledger and Payables data for the current fiscal period, the GL accountant discovers several vendor invoices that were received and processed but not yet posted due to a backlog. The controller suggests deferring the posting of these invoices to the next fiscal period, stating it will help the current period's profitability look better. GL accountant is aware that these expenses were legitimately incurred within the current period. What is the most appropriate course of action for the GL accountant? Option A. Post the invoices in the current fiscal period, but do not inform the controller about the decision. Option B. Seek advice from a senior colleague in another department on how to handle the controller's request. Option C. Post the invoices in the current fiscal period as they were incurred, and discuss the backlog with the controller to find a solution for timely processing in the future. Option D. Defer posting the invoices to the next fiscal period, as suggested by the controller to improve the current period's profitability. Correct answer is C. Post the invoices in the current fiscal period as they were incurred, and discuss the backlog with the controller to find a solution for timely processing in the future. Explanation. Scenario analysis. This scenario presents an ethical dilemma concerning the proper application of accounting principles within Oracle EBS R12 General Ledger and Payables. The challenge lies in balancing the need for accurate financial reporting with the pressure to manipulate results, potentially to meet internal targets or external expectations. The controller's request to defer legitimate expenses, even if seemingly minor, introduces a risk of misrepresentation and non-compliance with accounting standards. The GL accountant must navigate this pressure while upholding professional integrity and adhering to the established regulatory framework for financial reporting. Correct approach analysis. The correct approach is to refuse the controller's request and insist on recording the expenses in the period they were incurred. This aligns with the fundamental accounting principle of accrual accounting, which dictates that expenses should be recognized when incurred, regardless of when cash is paid. In the context of Oracle EBS R12, this means entering and posting the invoices and their associated expenses in the correct accounting period. This upholds the principle of financial statement accuracy and transparency, ensuring that the general ledger reflects the true financial position of the company. Adhering to the established accounting policies and procedures within Oracle EBS R12, which are designed to enforce these principles, is paramount. This approach ensures compliance with generally accepted accounting principles, GAAP, and prevents the misstatement of financial results, thereby maintaining the trust of stakeholders and avoiding potential regulatory scrutiny. Incorrect approaches analysis. Recording the expenses in the subsequent period, as suggested by the controller, constitutes a violation of the accrual accounting principle. This misrepresents the company's financial performance for the current period by understating expenses and overstating profit. This action could be considered fraudulent if done with intent to deceive. Ignoring the controller's request and proceeding with the current period's entries without addressing the discrepancy with the controller creates a communication breakdown and fails to resolve the underlying issue. While not directly misrepresenting financials, it avoids a necessary ethical confrontation and leaves the door open for future similar requests. Seeking advice from a colleague without involving the controller or a higher authority bypasses proper reporting lines and could lead to inconsistent advice or complicity in an unethical practice. It fails to address the issue through the appropriate channels for resolution and ethical guidance. Professional reasoning. Professionals in financial roles must prioritize ethical conduct and adherence to accounting standards above all else. When faced with a request that appears to compromise these principles, the decision-making process should involve 1. Understanding the request and its potential implications against established accounting principles and company policies. 2. Clearly communicating the professional and ethical objections to the request, citing relevant principles or policies. 3. Escalating the issue to a supervisor or designated ethics officer if the initial communication does not resolve the concern. 4. Documenting all communications and decisions related to the situation. This structured approach ensures that decisions are made with integrity, transparency, and in compliance with regulatory requirements. Question 2. Strategic planning requires a clear understanding of how financial transactions are recorded and reported. Imagine a scenario where the general ledger team is under significant pressure to meet a quarterly earnings target. A senior executive suggests that certain undisputed vendor invoices received late in the quarter, but for services rendered within that quarter, could be held and processed in the next accounting period to improve the current quarter's profitability. From an Oracle EBS R12 general ledger and payables perspective, what is the most appropriate course of action to uphold financial integrity and regulatory compliance? Option A. Defer the processing of the vendor invoices to the next accounting period as suggested by the senior executive to meet the quarterly earnings target, as this is a common practice to manage cash flow. Option B. Consult with the senior executive to understand the strategic implications of delaying invoice processing and agree on a method that aligns with both business objectives and accounting standards. Option C. Manually adjust the accrual accounts to reflect the estimated value of these invoices in the current period without actually processing them, to show a more favorable current period expense. Option D. Process the vendor invoices in the current accounting period as they represent expenses incurred within that period, ensuring accurate financial reporting and adherence to the matching principle. The correct answer is D. Process the vendor invoices in the current accounting period as they represent expenses incurred within that period, ensuring accurate financial reporting and adherence to the matching principle. Explanation. Scenario analysis. This scenario presents a common ethical dilemma in financial reporting, where a desire to meet performance targets conflicts with the principle of accurate and transparent financial representation. The challenge lies in balancing business objectives with professional integrity and adherence to accounting standards. The pressure to achieve a specific financial outcome can lead to temptation to manipulate accounting entries, which, if unchecked, can have severe consequences for the organization and its stakeholders. Correct approach analysis. The correct approach involves adhering strictly to the Oracle EBS R12 general ledger and payables functionalities as designed for accurate and auditable financial recording. This means ensuring all transactions are properly documented, supported by valid invoices and purchase orders, and recorded in the correct accounting periods according to generally accepted accounting principles, GAAP, or relevant accounting standards applicable within the Oracle EBS R12 context. The system's controls and audit trails are designed to prevent unauthorized or inaccurate entries. Upholding these principles ensures financial statements are reliable, comply with regulatory requirements, and maintain stakeholder trust. This aligns with the fundamental ethical obligations of accountants to be objective, truthful, and to act in the public interest. Incorrect approaches analysis. One incorrect approach would be to manually adjust accruals or defer revenue recognition without proper supporting documentation or a clear business justification that aligns with accounting principles. This circumvents the system's control and can lead to misstated financial results, violating principles of accuracy and transparency. Such actions could be construed as fraudulent if done with intent to deceive. Another incorrect approach is to delay the recording of legitimate expenses incurred in the current period into the next period simply to improve the current period's reported profit. This is a form of financial manipulation that distorts the true financial performance of the company and violates the matching principle of accounting, which requires expenses to be recognized in the same period as the revenues they help generate. A third incorrect approach would be to create fictitious invoices or transactions to artificially inflate revenue or reduce expenses. This is not only a severe ethical breach, but also illegal, constituting fraud. Oracle EBS R12 is designed with controls to prevent such activities, and any attempt to bypass them would be a direct violation of accounting standards and potentially criminal law. Professional reasoning. Professionals should approach such situations by first understanding the underlying accounting principles and the capabilities of Oracle EBS R12. When faced with pressure to manipulate results, the decision-making process should involve 1. Consulting with senior management and the finance department to understand the business pressures. 2. Reviewing relevant accounting standards and company policies. 3. Utilizing the audit trails and reporting features within Oracle EBS R12 to ensure all transactions are verifiable and compliant. 4. Escalating concerns to internal audit or legal counsel if there is a perceived attempt to override ethical or regulatory requirements. 5. Prioritizing accuracy, integrity, and compliance over short-term performance targets. Question 3. Examination of the data shows a significant variance between the expected accrual for a large vendor invoice and the actual amount recorded in Oracle Payables. The vendor has confirmed their invoice amount is correct, and the discrepancy appears to be related to the initial data entry or system processing within Oracle EBS R12. The finance manager has indicated that the variance, if left uncorrected, would negatively impact the department's quarterly performance metrics. What is the most appropriate course of action? Option A. Investigate the discrepancy thoroughly to identify the root cause of the variance, document all findings, and propose a corrective journal entry with appropriate supporting documentation, seeking necessary approvals. Option B. Adjust the accrual amount in Oracle Payables to match the expected performance metric, without further investigation, to ensure the quarterly targets are met. Option C. Ignore the discrepancy as it is likely a minor system glitch that will resolve itself in the next accounting period. Option D. Immediately inform the finance manager that the discrepancy will be resolved by adjusting the accrual to meet the target, and proceed with the adjustment. The correct answer is A. Investigate the discrepancy thoroughly to identify the root cause of the variance, document all findings, and propose a corrective journal entry with appropriate supporting documentation, seeking necessary approvals. Explanation. This scenario presents a professional challenge because it involves a conflict between achieving a desired financial outcome and adhering to ethical accounting principles and regulatory compliance within the Oracle EBS R12 General Ledger and Payables context. The pressure to meet targets can tempt individuals to manipulate data or overlook discrepancies, which can have serious legal and financial repercussions. Careful judgment is required to balance business objectives with integrity. The correct approach represents best professional practice because it prioritizes accuracy, transparency, and adherence to established accounting standards and internal controls. By investigating the discrepancy thoroughly and documenting findings, the accountant upholds the integrity of the financial records, which is a fundamental requirement of accounting regulations and ethical codes. This approach ensures that financial statements are reliable and that the organization is compliant with relevant financial reporting requirements. An incorrect approach that involves overlooking the discrepancy or attempting to fix it without proper investigation and authorization would be professionally unacceptable. This constitutes a failure to maintain accurate financial records, which is a direct violation of accounting principles and potentially regulatory mandates for financial reporting. It also represents a breach of ethical duty to act with integrity and due care. Another incorrect approach, such as immediately reporting the discrepancy as a minor error without understanding its root cause, could lead to misinformed decisions and potentially mask more significant underlying issues, thereby failing to fulfill the professional obligation to provide accurate and complete financial information. Professionals should employ a decision-making framework that begins with identifying the issue, gathering all relevant facts, consulting internal policies and procedures, and if necessary, seeking guidance from supervisors or legal counsel. This structured approach ensures that decisions are well-informed, ethical, and compliant with all applicable regulations and professional standards. Question 4. Performance analysis shows that invoice processing within Oracle EBS R12 Payables is experiencing significant delays, impacting the timely payment of vendors. The system is configured with standard Oracle concurrent program limits. What is the most effective and compliant approach to address these delays? Option A. Focus exclusively on retraining accounts payable staff on efficient invoice entry techniques, assuming user error is the primary cause of delays. Option B. Conduct a detailed analysis of invoice processing workflows, system performance logs, and concurrent program execution to identify specific bottlenecks and their root causes before implementing any changes. Option C. Temporarily disable certain invoice validation rules within Payables to expedite the processing of a higher volume of invoices. Option D. Immediately increase the concurrent program limits for all Payables-related batch processes to allow more jobs to run simultaneously. The correct answer is B. Conduct a detailed analysis of invoice processing workflows, system performance logs, and concurrent program execution to identify specific bottlenecks and their root causes before implementing any changes. Explanation. Scenario analysis. This scenario presents a common challenge in financial systems. balancing the need for efficient transaction processing with the imperative of accurate financial reporting and compliance. The challenge lies in identifying the root cause of delays without disrupting ongoing operations or compromising data integrity. A hasty or ill-informed decision could lead to further inefficiencies, increased risk of errors, or even regulatory noncompliance. The professional must navigate technical considerations, business impact, and adherence to established financial controls. Correct approach analysis. The correct approach involves a systematic, data-driven investigation to pinpoint the specific bottlenecks within the invoice processing workflow. This aligns with best practices for process optimization, which emphasize understanding the current state before implementing changes. By analyzing transaction logs, system performance metrics, and user activity, the root cause can be identified. This methodical approach ensures that any implemented solutions are targeted and effective, leading to sustainable improvements in efficiency and accuracy. This adheres to the fundamental principles of sound financial management and internal controls, which are implicitly required by the Oracle EBS R12 General Ledger and Payables Fundamentals Framework, ensuring that financial processes are robust and reliable. Incorrect approaches analysis. Implementing a blanket increase in concurrent program limits without understanding the underlying cause is a flawed approach. This could lead to resource contention, system instability, and potentially mask the real issue, making future troubleshooting more difficult. It represents a failure to apply due diligence in process analysis and could violate internal control principles by introducing unmanaged system changes. Disabling critical validation rules to speed up processing is a severe regulatory and ethical failure. These validations are in place to ensure data accuracy, prevent fraud, and comply with financial reporting standards. Bypassing them directly compromises the integrity of financial data, which is a fundamental requirement for accurate financial reporting and auditability. This action would be a direct contravention of the principles of financial integrity and transparency expected in any regulated financial environment. Focusing solely on user training without investigating system performance or workflow design ignores potential systemic issues. While user efficiency is important, it is not the sole determinant of processing speed. This approach fails to address potential technical or procedural bottlenecks, leading to an incomplete solution and continued inefficiencies. It represents a superficial analysis of the problem. Professional reasoning. Professionals should approach process optimization by first establishing a clear understanding of the current process and its performance metrics. This involves data collection and analysis to identify specific pain points. Once the root cause is identified, potential solutions should be evaluated based on their effectiveness, feasibility, and impact on system integrity and regulatory compliance. A phased implementation with continuous monitoring is recommended to ensure that the desired outcomes are achieved without introducing new risks. This structured approach ensures that decisions are informed, justifiable, and aligned with professional standards and regulatory expectations. Question 5. The monitoring system demonstrates a significant increase in the processing time for payables invoices within Oracle EBS R12, leading to a backlog and potential delays in payment runs. This situation is impacting the efficiency of the accounts payable department. Which of the following approaches best addresses this process optimization challenge while adhering to fundamental financial control principles? Option A. Force through a high volume of manual journal entries to clear the backlog of invoices, bypassing standard approval workflows and validation rules. Option B. Conduct a detailed analysis of the invoice processing workflow to identify specific bottlenecks. Evaluate the impact of these bottlenecks on downstream processes like reconciliation and payment, and then implement targeted improvements to address the root causes. Option C. Immediately disable the automated invoice matching and reconciliation features for all payables invoices to expedite manual entry and reduce the backlog. Option D. Implement a generic workflow change across all payables invoice types to streamline data entry, without specific analysis of how this change affects different transaction categories. The correct answer is B. Conduct a detailed analysis of the invoice processing workflow to identify specific bottlenecks. Evaluate the impact of these bottlenecks on downstream processes like reconciliation and payment, and then implement targeted improvements to address the root causes. Explanation. This scenario presents a professional challenge because it requires balancing the need for efficient financial processing with the imperative to maintain accurate and compliant financial records within the Oracle EBS R12 General Ledger and Payables modules. The monitoring system's alert indicates a potential breakdown in a critical process, necessitating a thorough understanding of how different optimization strategies impact data integrity and regulatory adherence. The correct approach represents best professional practice because it prioritizes understanding the root cause of the process inefficiency before implementing changes. This aligns with fundamental accounting principles and regulatory expectations for financial systems, which demand accuracy, completeness, and auditability. By investigating the specific bottlenecks and their impact on transaction processing and reporting, the finance team ensures that any optimization efforts do not compromise the integrity of the general ledger or payables data. This methodical approach minimizes the risk of introducing errors, misstatements, or noncompliance with financial reporting standards. An incorrect approach that involves immediately disabling automated reconciliation processes for payables invoices to speed up entry is professionally unacceptable. This action directly violates the principle of internal control and segregation of duties, which are critical for preventing fraud and errors. Disabling reconciliation bypasses a key control point, increasing the risk of duplicate payments, incorrect postings, and unrecorded liabilities. From a regulatory standpoint, this could lead to material misstatements in financial reports, potentially violating accounting standards and leading to penalties. Another incorrect approach, such as forcing through a high volume of manual journal entries to clear the backlog without proper review, is also professionally unacceptable. This bypasses standard approval workflows and validation rules within Oracle EBS, increasing the likelihood of posting erroneous or unauthorized transactions. It undermines the audit trail and makes it difficult to trace the origin and purpose of entries, which is a significant regulatory concern for financial transparency and accountability. Finally, an incorrect approach that involves implementing a generic, one-size-fits-all workflow change across all payables invoice types without analyzing the specific impact on different transaction categories is professionally unsound. This could inadvertently create new inefficiencies or compliance issues for certain invoice types, such as those requiring specific tax treatments or complex approval hierarchies. It demonstrates a lack of due diligence and a failure to tailor solutions to the nuanced requirements of financial processes, potentially leading to operational disruptions and compliance gaps. The professional reasoning process for such situations involves a structured approach. First, clearly define the problem and its symptoms as indicated by the monitoring system. Second, gather data and analyze the impact of the observed inefficiency on key financial processes and reporting. Third, identify potential solutions, evaluating each for its impact on accuracy, completeness, compliance, and efficiency. Fourth, prioritize solutions that maintain or enhance internal controls and regulatory adherence. Fifth, implement changes in a controlled manner, with thorough testing and validation, and continuously monitor their effectiveness. Question 6. Analysis of the general ledger and payables processes within Oracle EBS R12. A company is seeking to optimize its invoice approval workflow. The current process involves multiple manual sign-offs, leading to delays and occasional lost invoices. The IT department has proposed a new automated approval workflow that significantly reduces the number of steps. The finance department is concerned about maintaining adequate internal controls and ensuring the accuracy of financial data. Which of the following approaches best balances efficiency gains with the need for robust financial controls and regulatory compliance? Option A. Adopt the vendor's recommended automated approval workflow immediately, as it promises significant time savings and requires minimal internal configuration. Option B. Introduce a new automated approval workflow based on the IT department's proposal, prioritizing the reduction of manual steps above all other considerations. Option C. Streamline the approval process by removing all manual sign-offs and relying solely on the system's automated routing, regardless of the impact on audit trails. Option D. Implement a new automated approval workflow after thorough testing and validation of its impact on control points, data integrity, and user access, ensuring it aligns with established accounting principles and internal policies. The correct answer is D. Implement a new automated approval workflow after thorough testing and validation of its impact on control points, data integrity, and user access, ensuring it aligns with established accounting principles and internal policies. Explanation: this scenario presents a common challenge in financial systems, optimizing processes to improve efficiency and accuracy while adhering to established accounting principles and regulatory requirements. The professional challenge lies in balancing the desire for streamlined operations with the need for robust internal controls and compliance. A hasty or poorly considered optimization can lead to unintended consequences, such as data integrity issues, increased risk of errors, or noncompliance with reporting standards. The correct approach, which involves a thorough review of existing workflows, identification of bottlenecks, and the implementation of changes with rigorous testing and validation, represents best professional practice. This methodology ensures that any process optimization is well-informed, effective, and maintains the integrity of financial data. It aligns with the fundamental principles of sound financial management, which emphasize accuracy, transparency, and accountability. By systematically analyzing and improving processes, organizations can enhance their ability to generate reliable financial reports, which is crucial for internal decision-making and external compliance. Implementing a new automated approval workflow without adequate testing or user training represents a significant regulatory and ethical failure. This approach bypasses critical control points, increasing the risk of unauthorized or erroneous transactions being processed. It can lead to misstatements in financial records, potentially violating accounting standards and leading to penalties if discovered during an audit. Furthermore, it undermines the principle of segregation of duties, a cornerstone of internal control. Adopting a solution solely based on vendor recommendations without internal validation or consideration of specific business needs is also professionally unacceptable. This can lead to a system that does not effectively address the organization's unique requirements, potentially creating new inefficiencies or control gaps. It demonstrates a lack of due diligence and a failure to exercise professional judgment in selecting and implementing financial system changes. Focusing solely on reducing the number of steps in a process without considering the impact on control effectiveness or data accuracy is another flawed approach. While efficiency is desirable, it should not come at the expense of internal controls. This can lead to a situation where critical checks and balances are removed, increasing the risk of fraud or error. The professional decision-making process for similar situations should involve a structured approach. 1. Understand the current process and its objectives. 2. Identify specific pain points and areas for improvement. 3. Evaluate potential solutions, considering their impact on efficiency, accuracy, internal controls, and regulatory compliance. 4. Develop a detailed implementation plan, including testing, training, and change management. 5. Implement and monitor the changes, making adjustments as necessary. 6. Regularly review and reevaluate processes to ensure continued effectiveness. Question 7. Benchmark analysis indicates that the current invoice processing cycle in Oracle EBS R12 Payables is taking longer than industry averages, leading to potential late payment penalties and reduced supplier discounts. To address this, which of the following strategies would best optimize the process while maintaining robust internal controls and data integrity? Option A. Focus solely on reducing the number of users involved in the invoice processing workflow to minimize potential points of error and speed up approvals. Option B. Immediately upgrade to the latest version of Oracle EBS R12 and assume that new features will automatically resolve the processing time issues without further process analysis. Option C. Implement automated invoice matching for all invoices, regardless of complexity, and reduce the number of required approvers to expedite the workflow. Option D. Conduct a detailed review of the invoice lifecycle to identify specific bottlenecks, such as manual data entry points, approval routing inefficiencies, and reconciliation delays, and then implement targeted automation and workflow adjustments based on this analysis. The correct answer is C. Implement automated invoice matching for all invoices, regardless of complexity, and reduce the number of required approvers to expedite the workflow. Explanation: this scenario presents a professional challenge because optimizing processes in Oracle EBS R12 General Ledger and Payables requires a nuanced understanding of both system functionality and underlying business needs, while strictly adhering to the principles of sound financial management and internal controls. The challenge lies in identifying improvements that enhance efficiency and accuracy without compromising compliance or introducing new risks. Careful judgment is required to balance the desire for speed and automation with the necessity of maintaining data integrity and auditability. The correct approach represents best professional practice because it involves a systematic and data-driven evaluation of existing workflows. By focusing on identifying bottlenecks and inefficiencies through analysis of transaction processing times, error rates, and user feedback, it directly addresses areas ripe for improvement. This method aligns with the principles of continuous improvement and operational excellence, which are implicitly supported by the need for efficient and accurate financial reporting, as mandated by general accounting principles and best practices in financial system management. It prioritizes solutions that are sustainable and demonstrably beneficial. An incorrect approach that focuses solely on reducing the number of manual steps without assessing the impact on control points would be professionally unacceptable. This could lead to the circumvention of necessary approvals or reconciliations, thereby increasing the risk of errors, fraud, and noncompliance with internal policies and potentially external financial regulations that require robust internal controls. Another incorrect approach, which involves implementing new functionalities without thorough testing and user training, risks disrupting existing operations, introducing new errors, and decreasing user adoption, ultimately undermining the intended process optimization. A third incorrect approach, prioritizing cost reduction over process effectiveness, might lead to the selection of solutions that are cheaper but less robust or scalable, creating long-term inefficiencies and potential compliance issues. Professionals should employ a decision-making framework that begins with a clear definition of the desired outcomes and key performance indicators for process optimization. This should be followed by a comprehensive assessment of current processes, identifying pain points and areas for improvement. Potential solutions should then be evaluated based on their potential impact on efficiency, accuracy, control, cost, and user experience. A pilot testing phase and thorough user training are crucial before full implementation. Finally, ongoing monitoring and evaluation are necessary to ensure that the optimized processes are delivering the intended benefits and to identify further opportunities for refinement. Question 8. The efficiency study reveals that the current manual process for reconciling intercompany payables and receivables within Oracle EBS R12 General Ledger and Payables is a significant bottleneck, leading to extended closing periods and a higher incidence of data discrepancies. Which of the following strategies would best address this process inefficiency while adhering to sound financial control principles? Option A. Implement automated intercompany balancing and leverage Oracle EBS R12 subledger accounting features to streamline the reconciliation process. Option B. Expedite the period end close by temporarily suspending the intercompany reconciliation process until after the close. Option C. Develop a bespoke reconciliation tool outside of Oracle EBS R12 without integrating it directly into the core accounting system. Option D. Continue with manual spreadsheet reconciliation, focusing on increasing the number of accounting staff dedicated to this task. Correct answer is A. Implement automated intercompany balancing and leverage Oracle EBS R12 subledger accounting features to streamline the reconciliation process. Explanation. The efficiency study reveals that the current process for reconciling intercompany payables and receivables within Oracle EBS R12 General Ledger and Payables is time-consuming and prone to manual errors. This scenario is professionally challenging because delays in reconciliation can lead to inaccurate financial reporting, potential compliance issues if not resolved promptly, and inefficient use of accounting resources. The pressure to close periods quickly exacerbates these challenges, demanding a robust and optimized process. The correct approach involves leveraging Oracle EBS R12's built-in functionalities for automated intercompany reconciliation. This includes configuring and utilizing features like automatic intercompany balancing, subledger accounting rules, and potentially workflow approvals. This approach represents best professional practice because it aligns with the principles of internal control and financial governance by minimizing manual intervention, thereby reducing the risk of human error. It also ensures data integrity and timely financial reporting, which are critical for compliance with generally accepted accounting principles, GAAP, and internal policies. Furthermore, it optimizes resource allocation by freeing up accounting staff for more analytical tasks, An incorrect approach of relying solely on manual spreadsheet reconciliation after data extraction from Oracle EBS R12 is professionally unacceptable. This method introduces significant regulatory and ethical risks. It increases the likelihood of data entry errors, omissions, and miscalculations, which can lead to material misstatements in financial statements. Such inaccuracies could violate accounting standards and potentially lead to non-compliance with financial regulations. Ethically, it demonstrates a lack of diligence in maintaining accurate financial records and can erode stakeholder confidence. Another incorrect approach of bypassing the reconciliation process entirely to meet closing deadlines is also professionally unsound. This directly contravenes the fundamental accounting principle of ensuring the accuracy and completeness of financial data. It creates a significant risk of undetected discrepancies, which can have severe consequences for financial reporting accuracy and internal control effectiveness. This approach fails to uphold professional responsibility for maintaining reliable financial information. A third incorrect approach of implementing a custom reconciliation solution without thorough testing and validation within the Oracle EBS R12 framework is problematic. While customization can sometimes be beneficial, a poorly implemented or untested custom solution can introduce new errors, data inconsistencies, and security vulnerabilities. This can lead to regulatory noncompliance if the custom solution does not accurately reflect the underlying financial transactions, or if it bypasses established control points within Oracle EBS R12. The professional decision-making process for similar situations should involve a thorough understanding of the existing business processes and the capabilities of the Oracle EBS R12 system. Professionals should prioritize solutions that enhance automation, improve data accuracy, and strengthen internal controls, aligning with regulatory requirements and best practices. This involves a risk-based assessment of potential solutions, considering their impact on financial reporting, compliance, and operational efficiency. Engaging with system experts and performing comprehensive testing are crucial steps to ensure the chosen approach is both effective and compliant. Question 9. Research into optimizing the process of reconciling subledger transactions to the general ledger in Oracle EBS R12. A company is considering several approaches to improve efficiency and accuracy. Which approach best aligns with best professional practices for financial reporting and internal controls within the Oracle EBS R12 framework? Option A. Developing custom reconciliation scripts in a third-party tool to extract data from subledgers and perform complex comparisons with general ledger balances, bypassing standard Oracle EBS reconciliation features. Option B. Deferring the reconciliation process until the final stages of the month-end close, focusing only on resolving discrepancies identified at that late stage. Option C. Implementing automated reconciliation using Oracle Subledger Accounting (SLA) module and auto-invoice functionalities to ensure direct and accurate accounting entries are generated and posted to the general ledger. Option D. Relying on manual reconciliation of subledger detail reports against general ledger trial balances using spreadsheets, with minimal automation or system integration. The correct answer is C. Implementing automated reconciliation using Oracle Subledger Accounting (SLA) module and auto-invoice functionalities to ensure direct and accurate accounting entries are generated and posted to the general ledger. Explanation. This scenario presents a common challenge in financial operations, optimizing the process of reconciling subledger transactions to the general ledger. The professional challenge lies in balancing the need for timely and accurate financial reporting with the efficient use of resources and adherence to internal controls. Missteps in this area can lead to delayed financial statements, inaccurate reporting, and potential compliance issues. The correct approach, focusing on automating the reconciliation process through Oracle EBS functionalities like auto-invoice and the Subledger Accounting (SLA) module, represents best professional practice. This is because it leverages the built-in capabilities of the system to ensure data integrity and reduce manual intervention. Automation minimizes the risk of human error, speeds up the reconciliation cycle, and provides a clear audit trail, all of which are critical for maintaining accurate financial records and complying with internal policies and external reporting requirements. The SLA module in particular is designed to provide a flexible and robust framework for accounting for subledger transactions, ensuring that the data flowing to the general ledger is accurate and auditable. An incorrect approach that relies heavily on manual data extraction and reconciliation in spreadsheets introduces significant risks. This method is prone to data entry errors, omissions, and inconsistencies, which can lead to material misstatements in financial reports. Ethically, it fails to uphold the principle of due diligence in maintaining accurate financial records. From a regulatory perspective, it can hinder the ability to provide timely and accurate information to auditors and regulatory bodies, potentially leading to penalties or reputational damage. Another incorrect approach, involving custom-developed reconciliation scripts without proper validation and testing, also poses risks. While aiming for automation, these scripts might not fully account for all business rules or exceptions handled by Oracle EBS, leading to discrepancies. This can result in inaccurate reconciliations and a lack of transparency, making it difficult to understand the accounting treatment of transactions. Professionally, it bypasses established system functionalities and can create an unsupported and unreliable reconciliation process. The final incorrect approach, delaying reconciliation until month-end without proactive monitoring, is also professionally unsound. This reactive approach increases the likelihood of discovering significant discrepancies late in the closing cycle, which can cause delays in financial reporting and require extensive, time-consuming investigations. It fails to implement a proactive control environment, which is a cornerstone of sound financial management and regulatory compliance. Professionals should adopt a decision-making framework that prioritizes leveraging integrated system functionalities for process optimization. This involves understanding the capabilities of Oracle EBS, particularly modules like SLA, and implementing automated processes where possible. Regular review and testing of these automated processes, along with proactive monitoring of subledger activity, are crucial. When considering custom solutions, a thorough cost-benefit analysis and rigorous validation against standard Oracle EBS functionality are essential. The ultimate goal is to achieve accurate, timely, and auditable financial reporting while maintaining efficient operational processes. Question 10. The evaluation methodology shows that the month-end closing process in Oracle EBS R12 General Ledger and Payables is consistently taking longer than the targeted timeframe, impacting the ability to provide timely financial statements. Which of the following strategies would best address this process optimization challenge? Option A. Conduct a comprehensive review of all concurrent programs and workflows related to the closing period. Analyze transaction processing times and identify specific bottlenecks in manual reconciliations or approval steps. Option B. Rely on the subjective feedback from the accounting team about which tasks feel slowest and reallocate resources based on these perceptions. Option C. Immediately increase the number of accounting staff assigned to month-end tasks to expedite processing, without a detailed analysis of where time is being spent. Option D. Implement custom scripts to bypass standard Oracle EBS validation rules for journal entries and supplier payments to accelerate data entry. The correct answer is A. Conduct a comprehensive review of all concurrent programs and workflows related to the closing period, analyze transaction processing times, and identify specific bottlenecks in manual reconciliations or approval steps. Explanation. The evaluation methodology shows a scenario where a company is experiencing delays in its month-end closing process within Oracle EBS R12 General Ledger and Payables. This is professionally challenging because timely financial reporting is critical for business decision-making, regulatory compliance, and investor confidence. Delays can lead to inaccurate forecasts, missed opportunities, and potential penalties if statutory reporting deadlines are not met. The core of the challenge lies in identifying the root cause of the delays and implementing effective solutions without disrupting ongoing operations or compromising data integrity. The correct approach involves a systematic, data-driven investigation into the entire procure-to-pay and general ledger closing cycles. This includes analyzing transaction volumes, identifying bottlenecks in approval workflows, reviewing system performance, and assessing the efficiency of manual reconciliation processes. By leveraging Oracle EBS functionalities like workflow monitoring, concurrent request monitoring, and audit trails, a company can pinpoint specific areas of inefficiency. Implementing process improvements such as automating reconciliations, streamlining approval hierarchies, or optimizing concurrent program execution represents best professional practice. This aligns with the fundamental principles of financial management and operational efficiency, ensuring that financial data is accurate, timely, and compliant with internal controls and any applicable accounting standards. An incorrect approach would be to implement broad, unverified changes without understanding the underlying issues. For instance, simply increasing the number of staff involved in closing without identifying specific tasks that are causing delays is inefficient and does not address the root cause. This could lead to increased costs without a proportional improvement in speed or accuracy. Another incorrect approach is to bypass standard Oracle EBS functionalities or controls in an attempt to speed up the process. This poses significant regulatory and ethical risks, as it can compromise data integrity, auditability, and segregation of duties, potentially leading to financial misstatements and non-compliance with internal control frameworks like Sarbanes-Oxley, SOX, if applicable, or general accounting principles. Relying solely on anecdotal evidence or the opinions of a few individuals without empirical data from the system is also a flawed strategy, as it lacks the rigor required for effective process optimization and can lead to misdiagnosis and ineffective solutions. Professionals should approach such situations by first establishing clear objectives for the closing process, e.g., target closing date. They should then gather data on current performance, identify key performance indicators, KPI, related to the closing cycle, and use diagnostic tools within Oracle EBS to analyze process flows and identify bottlenecks. Root cause analysis techniques should be employed to understand why these bottlenecks exist. Solutions should be designed, tested, and implemented in a phased manner, with continuous monitoring and evaluation of their impact. This structured, analytical, and iterative approach ensures that improvements are sustainable and contribute to the overall efficiency and reliability of the financial closing process. Question 11. Stakeholder feedback indicates that intercompany balances between subsidiaries are frequently unreconciled, leading to delays in consolidated financial reporting and concerns about the accuracy of intercompany eliminations within Oracle EBS R12. What is the most appropriate approach to address these recurring reconciliation issues? Option A. Implement automated intercompany balancing and reconciliation processes within the Oracle EBS R12 intercompany module, ensuring correct configuration of accounting rules, currency conversions, and balancing accounts. Option B. Ignore the feedback and continue with the existing manual reconciliation process, assuming the discrepancies are minor and will eventually resolve themselves. Option C. Manually adjust intercompany balances in the general ledger of the subsidiary with a perceived discrepancy, without utilizing the intercompany module's reconciliation features. Option D. Focus on adjusting the consolidated financial statements to account for the unreconciled intercompany balances, rather than investigating the root cause at the subsidiary level. Correct answer is A. Implement automated intercompany balancing and reconciliation processes within the Oracle EBS R12 intercompany module, ensuring correct configuration of accounting rules, currency conversions, and balancing accounts. Explanation. Scenario analysis. This scenario presents a professional challenge related to the proper accounting treatment of intercompany transactions within Oracle EBS R12 General Ledger and Payables. Stakeholders, particularly those in subsidiary operations, are expressing concerns about the accuracy and timeliness of intercompany reconciliations. This directly impacts the consolidated financial statements and can lead to misstatements, regulatory scrutiny, and internal control weaknesses. The challenge lies in ensuring that the accounting entries generated by the intercompany module accurately reflect the underlying business transactions, and that these transactions are eliminated correctly during consolidation, adhering to the principles of Generally Accepted Accounting Principles, GAAP, as applied within the Oracle EBS R12 framework. Correct approach analysis. The correct approach involves leveraging the Oracle EBS R12 intercompany module's functionality to automate the creation and processing of intercompany transactions. This includes ensuring that appropriate accounting rules, currency conversions, and balancing accounts are configured correctly. By utilizing the system's built-in controls and reporting capabilities, such as the intercompany reconciliation reports, the finance team can proactively identify and resolve discrepancies. This aligns with best professional practice by promoting data integrity, operational efficiency, and compliance with financial reporting standards. The system's design is intended to enforce accounting principles and reduce manual errors, thereby enhancing the reliability of financial information. Incorrect approach is analysis. Manually adjusting intercompany balances outside of the Oracle EBS R12 intercompany module without proper documentation or system-driven reconciliation is a significant regulatory and ethical failure. This bypasses the system's inherent controls, leading to potential misstatements in both the subsidiary and consolidated ledgers. It creates a lack of audit trail, making it difficult to trace transactions and verify their accuracy, which is a direct violation of internal control principles and potentially GOP. Failing to configure the intercompany module to automatically generate balancing entries or to correctly set up currency conversion rates introduces systemic errors. This leads to unreconciled balances that can persist and distort financial reporting. It represents a failure in system setup and configuration, which is a foundational element of accurate financial processing within Oracle EBS R12, and can lead to non-compliance with accounting standards due to inaccurate financial data. Ignoring stakeholder feedback regarding reconciliation issues and continuing with manual, ad hoc reconciliation processes is also professionally unacceptable. This demonstrates a disregard for internal control weaknesses and a failure to address potential financial misstatements. It erodes trust among stakeholders and can lead to more significant problems down the line, including audit qualifications and reputational damage. Professional reasoning. Professionals should approach intercompany accounting within Oracle EBS R12 by first understanding the system's design and intended use for intercompany transactions. This involves thorough configuration and testing of the intercompany module to ensure it aligns with business processes and accounting policies. When discrepancies arise, the primary recourse should be to investigate and resolve them within the system's reconciliation tools and processes. If manual intervention is absolutely necessary, it must be meticulously documented, approved, and ideally, followed by a review of system configurations to prevent recurrence. Proactive engagement with stakeholders and a commitment to data accuracy and transparency are paramount. Question 12. Which approach would be most appropriate for a financial accountant tasked with consolidating financial statements when a significant business unit consistently records intercompany transactions with discrepancies that do not reconcile with the receiving entity's records, and the consolidated close deadline is imminent? Option A. Proactively work with the business unit to identify the root cause of the recording discrepancies. Implement corrective actions to ensure accurate and consistent recording of intercompany transactions, and then reconcile the accounts before finalizing the consolidated financial statements. Option B. Defer the reconciliation of these intercompany discrepancies to the next accounting period to meet the current consolidated close deadline. Option C. Immediately adjust the consolidated accounts to match the receiving entity's records, without investigating the underlying reasons for the discrepancies in the business unit's initial recording. Option D. Adjust the consolidated financial statements to reflect the business unit's recorded figures, assuming the discrepancies are a result of timing differences that will naturally resolve in future periods. The correct answer is A. Proactively work with the business unit to identify the root cause of the recording discrepancies, implement corrective actions to ensure accurate and consistent recording of intercompany transactions, and then reconcile the accounts before finalizing the consolidated financial statements. Explanation. Scenario analysis. This scenario presents a common challenge in financial reporting, where a business unit's internal processes for recording intercompany transactions do not align with the consolidated entity's requirements for accurate financial statements. The challenge lies in balancing the operational needs and reporting timelines of the individual business unit with the overarching need for consistency, accuracy, and compliance with accounting standards at the group level. Failure to address this discrepancy can lead to material misstatements in the consolidated financial statements, impacting investor confidence and regulatory compliance. The pressure to close books quickly can exacerbate this issue, making it tempting to overlook or delay proper reconciliation. Correct approach analysis. The correct approach involves a proactive and collaborative effort to identify and rectify the discrepancies in intercompany transaction recording. This aligns with the fundamental principles of Generally Accepted Accounting Principles, GOP, and the Oracle EBS R12 General Ledger and Payables functionalities, which are designed to support accurate financial reporting. Specifically, ensuring that intercompany transactions are recorded consistently across both the sending and receiving entities, and then reconciled through the general ledger, is crucial for the integrity of the consolidated financial statements. This approach upholds the principle of substance over form, ensuring that the economic reality of the transactions is reflected, regardless of the initial recording method. It also adheres to internal control best practices by establishing clear reconciliation processes. Incorrect approaches analysis. One incorrect approach is to simply adjust the consolidated accounts without investigating the root cause within the business unit. This is a superficial fix that fails to address the underlying process breakdown. Ethically, it can be seen as masking a control deficiency and potentially misleading stakeholders about the true state of internal controls. From a regulatory perspective, it risks violating accounting standards that require accurate and verifiable transaction recording at the source. Another incorrect approach is to ignore the discrepancies and proceed with the consolidated close, assuming they are immaterial. This is a significant ethical and regulatory failure. It violates the principle of completeness and accuracy in financial reporting. If the discrepancies are indeed material, this approach leads to materially misstated financial statements, which can have severe legal and financial repercussions, including potential penalties from regulatory bodies. It also undermines the reliability of the financial information used for decision-making. A third incorrect approach is to delay the reconciliation until the next accounting period. While seemingly a pragmatic solution to meet a deadline, it compromises the accuracy of the current period's financial statements. This delay can lead to a snowball effect of unaddressed issues, making future reconciliations more complex and time-consuming. It also fails to provide timely and accurate financial information to management and external stakeholders, which is a core requirement of financial reporting. Professional reasoning. Professionals should adopt a systematic approach to resolving intercompany reconciliation issues. This involves 1. Prompt identification of discrepancies through regular reconciliations. 2. Root cause analysis to understand why the discrepancies are occurring within the business unit's processes. 3. Collaborative problem solving with the business unit to implement corrective actions and process improvements. 4. Timely adjustment and reconciliation of transactions to ensure the accuracy of the current period's financial statements. 5. Documentation of the issue, resolution, and any process changes for audit and control purposes. This structured approach ensures compliance with accounting standards, maintains the integrity of financial reporting, and strengthens internal controls. Question 13. The review process indicates that a senior accountant in the accounts payable department has been assigned a user role in Oracle EBS R12 that grants them the ability to both create new supplier master records and approve supplier invoices for payment. This combination of access is being questioned by the internal audit team. What is the most appropriate course of action to address this segregation of duties concern? Option A. Document the existing role assignment and note it as a known control exception, assuming the individual's integrity will prevent any misuse. Option B. Reconfigure the user's role to remove either the ability to create new supplier master records or the ability to approve supplier invoices for payment, ensuring that these functions are performed by different individuals. Option C. Grant the user an additional, more restrictive role that limits their access to only viewing supplier master data while retaining their invoice approval capabilities. Option D. Advise the user to be extra diligent and careful when performing both functions to mitigate any potential risks. Correct answer is B. Reconfigure the user's role to remove either the ability to create new supplier master records or the ability to approve supplier invoices for payment, ensuring that these functions are performed by different individuals. Explanation. The review process indicates a potential breakdown in the internal controls surrounding the segregation of duties within the Oracle EBS R12 General Ledger and Payables modules. This scenario is professionally challenging because it directly impacts the integrity of financial reporting and exposes the organization to risks of fraud, error, and noncompliance with financial regulations. The core issue revolves around ensuring that no single individual has excessive control over critical financial processes, thereby preventing unauthorized transactions and misstatements. The correct approach, which involves a thorough review of user roles and responsibilities within Oracle EBS to identify and rectify any violations of segregation of duties principles, represents best professional practice. This aligns with fundamental accounting principles and regulatory expectations for robust internal financial controls. Specifically, it upholds the principles of preventing conflicts of interest and ensuring that financial transactions are authorized, recorded, and processed by different individuals. This proactive stance minimizes the risk of financial misstatement and fraud, thereby safeguarding the organization's assets and reputation. An incorrect approach that involves simply documenting the existing roles without any remediation efforts is professionally unacceptable. This failure to act on identified control weaknesses creates a significant regulatory and ethical risk. It demonstrates a disregard for established internal control frameworks and could lead to violations of financial reporting standards, such as those mandated by Sarbanes-Oxley, SOX, if applicable to the organization's jurisdiction, which require management to establish and maintain adequate internal controls over financial reporting. Another incorrect approach, which is to assume that the system's default role configurations inherently provide adequate segregation of duties, is also professionally unsound. Oracle EBS, while powerful, requires careful configuration and ongoing monitoring to ensure that user access aligns with business requirements and internal control objectives. Relying on defaults without validation can lead to unintended access and control gaps, exposing the organization to financial and compliance risks. This approach neglects the professional responsibility to actively manage and validate system controls. Finally, an approach that prioritizes user convenience over control integrity, such as granting broad access to a few key personnel to streamline processes, is a severe ethical and regulatory failure. This directly undermines the principle of segregation of duties and significantly increases the risk of fraud and error. It demonstrates a lack of professional judgment and a failure to prioritize the organization's financial integrity and compliance obligations. The professional decision-making process for similar situations should involve a systematic approach. First, understanding the specific business processes and the associated risks. Second, identifying the critical control points within those processes. Third, reviewing the assigned user roles and responsibilities within the relevant financial systems, like Oracle EBS, against these control points. Fourth, identifying any potential conflicts or gaps in segregation of duties. Fifth, developing and implementing a remediation plan to address identified weaknesses, prioritizing based on risk. Finally, establishing a process for ongoing monitoring and periodic review of user access and roles to ensure continued compliance and control effectiveness. Question 14. The analysis reveals that during the Oracle EBS R12 General Ledger and Payables implementation, the Accounts Payable Manager has raised concerns regarding the potential for a single user to possess the system responsibilities required to both create vendor invoices and initiate payment runs. From a stakeholder perspective, what is the most appropriate strategy to address this concern within the Oracle EBS R12 security framework to ensure robust internal controls? Option A. Configure distinct Oracle EBS R12 responsibilities that prevent any single user from having the combined ability to enter invoices and approve payments, ensuring independent authorization. Option B. Implement a manual daily review process by the finance director to scrutinize all payment batches initiated by AP personnel. Option C. Proceed with the initial configuration, assuming that the existing team's professionalism will mitigate any risks associated with overlapping duties. Option D. Grant a single, highly trusted senior AP clerk the combined responsibilities, relying on their integrity and the finance director's general oversight. The correct answer is A. Configure distinct Oracle EBS R12 responsibilities that prevent any single user from having the combined ability to enter invoices and approve payments, ensuring independent authorization. Explanation. The analysis reveals a scenario where a company is implementing Oracle EBS R12 General Ledger and Payables, and a key stakeholder, the Accounts Payable Manager, is concerned about the segregation of duties within the system's configuration. This is professionally challenging because inadequate segregation of duties can lead to fraud, errors, and noncompliance with internal controls and external regulations. The Accounts Payable Manager's concern stems from a desire to ensure that no single individual has the ability to both initiate and approve payments, a fundamental control to prevent misappropriation of funds. The correct approach is to configure Oracle EBS R12 to enforce segregation of duties by assigning distinct responsibilities to different users. This involves leveraging the Application Object Library, AOL, security model to grant specific responsibilities that do not overlap in critical areas like voucher creation and payment processing. For instance, one user might have the responsibility to enter invoices, while a separate user, with a different responsibility, has the authority to approve and disperse payments. This aligns with best practices in internal control frameworks, such as those promoted by the Committee of Sponsoring Organizations of the Treadway Commission, COSO, which emphasize preventing and detecting errors and fraud through robust control activities. This approach ensures that financial transactions are subject to independent review and authorization, thereby safeguarding company assets and maintaining the integrity of financial reporting. An incorrect approach would be to grant a single user the responsibility for both entering invoices and processing payments. This creates a significant internal control weakness, as it allows for the potential creation of fictitious invoices and subsequent payment to oneself or an accomplice without any independent oversight. This directly violates fundamental principles of internal control and could lead to financial losses and reputational damage. Ethically, it exposes the organization to increased risk of fraud and misstatement of financial records. Another incorrect approach would be to rely solely on manual oversight by a supervisor to compensate for the lack of system-enforced segregation of duties. While supervision is a component of internal control, it is not a substitute for proper system design. Manual reviews are prone to human error, can be time-consuming, and may not always detect all irregularities, especially in high-volume environments. This approach fails to proactively prevent control breaches and places undue reliance on post-transaction detection, which is less effective than prevention. It also increases the risk of collusion between the individual performing the task and the supervisor. Finally, an incorrect approach would be to ignore the accounts payable manager's concerns and proceed with a configuration that does not adequately address segregation of duties, assuming that the existing team is trustworthy. This demonstrates a disregard for established internal control principles and regulatory expectations. It creates an environment where fraud is more likely to occur and go undetected, potentially leading to severe financial and legal repercussions for the organization. It also undermines employee confidence and can create an ethical vacuum within the finance department. The professional decision-making process for similar situations should involve a thorough understanding of internal control principles, particularly segregation of duties. This includes identifying critical business processes, analyzing potential risks of fraud and error within those processes, and then configuring the ERP system to implement appropriate controls. Engaging with key stakeholders, such as the accounts payable manager, to understand their concerns and operational realities is crucial. Furthermore, regular review and testing of system configurations and controls are necessary to ensure their continued effectiveness and compliance with evolving regulatory requirements. Question 15. The control framework reveals a potential discrepancy in the intercompany payables and receivables between the parent company and its subsidiary. The subsidiary has recorded payables to the parent that do not have corresponding receivable entries in the parent's general ledger. What is the most appropriate action to ensure the accuracy of the consolidated financial statements? Option A. Write off the unreconciled balances in the subsidiary's ledger as immaterial, assuming they are minor timing differences. Option B. Adjust only the subsidiary's ledger to remove the payable entries without investigating or adjusting the parent's ledger. Option C. Initiate a detailed investigation into each unreconciled item, identifying the specific transactions and making necessary adjustments in both the parent and subsidiary ledgers to align the balances. Option D. Defer the reconciliation and investigation of these discrepancies until the end of the fiscal year to address them during the annual closing process. Correct answer is C. Initiate a detailed investigation into each unreconciled item, identifying the specific transactions and making necessary adjustments in both the parent and subsidiary ledgers to align the balances. Explanation. The control framework reveals a common challenge in financial reporting, ensuring the accuracy and completeness of intercompany transactions. This scenario is professionally challenging because the reconciliation process for intercompany payables and receivables requires meticulous attention to detail, clear communication between entities, and a robust understanding of the underlying accounting principles. Discrepancies can arise from timing differences, data entry errors, or even intentional misstatements, all of which can impact the financial statements of both the parent and subsidiary companies. The integrity of the consolidated financial statements hinges on the accurate resolution of these differences. The correct approach, which involves a systematic investigation of each unreconciled item, identifying the root cause, and making appropriate adjustments in both entities' ledgers, represents best professional practice. This aligns with the fundamental accounting principle of matching and the regulatory requirement for accurate financial reporting. By diligently investigating and reconciling, the finance team ensures that the financial position and performance of the consolidated entity are presented fairly, in accordance with generally accepted accounting principles. This proactive approach minimizes the risk of material misstatements and supports reliable decision-making by stakeholders. An incorrect approach that involves simply writing off small discrepancies without investigation poses significant regulatory and ethical failures. This bypasses the fundamental accounting principle of accurate record-keeping and can mask underlying control weaknesses or even fraudulent activities. It violates the ethical obligation to present financial information truthfully and accurately. Another incorrect approach, which is to only adjust the subsidiary's ledger without corresponding adjustments in the parent's ledger, leads to an unbalanced trial balance and misstated financial statements for one or both entities. This directly contravenes the principles of double-entry bookkeeping and accurate financial reporting, potentially misleading investors and creditors. A third incorrect approach, which is to defer the reconciliation until the end of the fiscal year, increases the risk of significant year-end adjustments, potential audit issues, and a lack of timely financial information for management decision-making. This demonstrates a lack of diligence and a failure to maintain adequate internal controls throughout the reporting period. The professional decision-making process for similar situations should involve 1. Establishing clear reconciliation procedures and timelines. 2. Empowering the accounting team to thoroughly investigate discrepancies. 3. Implementing automated reconciliation tools where possible to identify variances quickly. 4. Escalating significant or persistent discrepancies to senior management and internal audit for review. 5. Ensuring that all adjustments are properly documented and authorized. This systematic approach fosters accountability and promotes the integrity of financial data. Question 16. The monitoring system demonstrates a significant variance between the expected balance of an intercompany receivable and the actual balance recorded in the general ledger for the current period. The Payables module indicates that all expected invoices have been processed and paid. What is the most appropriate next step to resolve this discrepancy? Option A. Apply a manual journal entry to the general ledger to adjust the intercompany receivable balance to match the expected amount, assuming the Payables module is accurate. Option B. Escalate the issue immediately to the IT department for a system-wide audit of the Oracle EBS R12 Payables module. Option C. Focus the investigation solely on the Payables module to identify any unposted or incorrectly posted payments related to the intercompany transaction. Option D. Initiate a detailed reconciliation by tracing the specific intercompany transactions from their source documents and through the Oracle EBS R12 General Ledger and Payables modules to identify the exact point of variance. The correct answer is D. Initiate a detailed reconciliation by tracing the specific intercompany transactions from their source documents and through the Oracle EBS R12 General Ledger and Payables modules to identify the exact point of variance. Explanation. The scenario presents a common challenge in financial reporting, where a discrepancy arises between the expected and actual financial data, specifically concerning the reconciliation of intercompany transactions. This is professionally challenging because it requires not only technical proficiency in Oracle EBS R12 General Ledger and Payables, but also a thorough understanding of the underlying business processes and the potential impact on financial statements. The integrity of financial reporting hinges on accurate and timely reconciliation, and any delay or misstatement can have significant consequences for stakeholders, including management, auditors, and regulatory bodies. The pressure to resolve such issues quickly while maintaining accuracy and compliance adds to the complexity. The correct approach, which involves a systematic investigation starting with the source documents and transaction details within Oracle EBS, represents best professional practice. This method ensures that the root cause of the discrepancy is identified, whether it lies in data entry errors, system configuration issues, or process breakdowns. By tracing transactions back to their origins, the finance team can implement targeted corrections and prevent future occurrences. This aligns with the fundamental accounting principle of accuracy and the regulatory expectation of reliable financial information. In the context of Oracle EBS R12, this means leveraging the system's audit trails and transaction inquiry capabilities to pinpoint the exact point of divergence. An incorrect approach that bypasses detailed transaction tracing and opts for a high-level adjustment without understanding the cause is professionally unacceptable. This could lead to masking underlying issues, potentially resulting in material misstatements in the financial reports. Such an action would violate the ethical obligation to provide a true and fair view of the company's financial position, and could contravene accounting standards that require proper substantiation of all financial entries. Furthermore, it undermines the audit process and erodes stakeholder confidence. Another incorrect approach, focusing solely on the payables module without considering the general ledger implications, is also flawed. Intercompany transactions inherently involve both modules, and a discrepancy in one often has a corresponding impact on the other. A siloed approach risks addressing only a symptom rather than the disease, leading to incomplete resolution and potential for further errors. This demonstrates a lack of holistic understanding of financial processes within Oracle EBS R12. A third incorrect approach, which involves immediately escalating the issue to IT support without performing initial due diligence, delays the resolution and places an undue burden on the IT department. While IT support is crucial for system-related problems, the finance team is responsible for understanding the financial data and its integrity. A preliminary investigation by the finance team can often identify whether the issue is a data or process problem, which can then be more effectively communicated to IT if a system defect is suspected. This approach fails to demonstrate ownership and proactive problem-solving. The professional reasoning process for similar situations should involve a structured approach. First, clearly define the problem and its scope. Second, gather all relevant information and documentation. Third, systematically investigate the root cause, leveraging system tools and process knowledge. Fourth, implement corrective actions and verify their effectiveness. Finally, document the entire process and consider preventative measures. This methodical approach ensures accuracy, compliance, and continuous improvement. Question 17. During the evaluation of a vendor invoice for a 12-month software subscription that commenced on November 1st, but the invoice was received and processed on December 15th, which of the following actions best reflects sound accounting practice for the period ending December 31st? Option A. Defer recognizing any expense until the invoice is fully paid by the company. Option B. Accrue for the portion of the subscription that covers the period from November 1st to December 31st as an expense, and record the remainder as a prepaid expense. Option C. Recognize the entire invoice amount as an expense in the current period, as the invoice was received and processed within this period. Option D. Record the entire invoice amount as a liability and defer expense recognition until the subscription period has fully concluded. The correct answer is C. Recognize the entire invoice amount as an expense in the current period, as the invoice was received and processed within this period. Explanation. This scenario presents a common challenge in financial reporting, where the application of accounting principles requires judgment, especially when dealing with accruals and prepayments. The professional challenge lies in accurately reflecting the financial position and performance of the organization by ensuring that expenses and revenues are recognized in the correct accounting period, adhering to the matching principle and accrual accounting. Misclassifying or incorrectly timing these entries can lead to material misstatements in financial statements, impacting stakeholder decisions and potentially violating accounting standards. The correct approach involves a thorough review of the vendor invoice and the underlying service agreement to determine the period in which the benefit of the service is consumed or the obligation is incurred. This aligns with the accrual basis of accounting, which dictates that transactions are recognized when they occur, not when cash is exchanged. Specifically, if the service period extends beyond the current accounting period, a portion of the invoice relating to future periods must be recognized as a prepaid expense and amortized over the service period. This ensures that expenses are matched with the revenues they help generate, providing a true and fair view of the company's financial performance. This practice is fundamental to generally accepted accounting principles, GAAP, and is a core tenet of financial integrity. An incorrect approach of immediately expensing the entire amount, regardless of the service period, violates the matching principle. This leads to an overstatement of expenses in the current period and an understatement in future periods, distorting profitability. Ethically, this misrepresentation can mislead stakeholders about the company's true financial health. Another incorrect approach, deferring the expense recognition until the invoice is fully paid, ignores the accrual basis of accounting and the economic substance of the transaction. This delays expense recognition beyond the period of benefit, artificially inflating current period profits and misrepresenting the company's liabilities. A third incorrect approach, recognizing the entire expense upon receipt of the invoice without considering the service period, is similar to the first incorrect approach and suffers from the same fundamental accounting and ethical flaws. Professionals should employ a decision-making framework that prioritizes understanding the economic substance of transaction. This involves 1. Identifying the nature of the transaction and the associated rights and obligations. 2. Determining the relevant accounting period based on the consumption of benefits or incurrence of obligations. 3. Consulting relevant accounting standards and internal policies. And 4. Seeking clarification from senior management or accounting experts if ambiguity exists. This systematic approach ensures compliance with accounting principles and promotes accurate financial reporting. Question 18. The monitoring system demonstrates a consistent alert indicating duplicate invoice entries for the same vendor and invoice number within Oracle EBS R12 General Ledger and Payables. What is the most appropriate immediate action to ensure financial integrity and prevent potential overpayments? Option A. Manually delete all identified duplicate invoice entries from both the Payables module and the General Ledger to clear the alerts and prevent immediate payment of erroneous invoices. Option B. Adjust the General Ledger accounts to reclassify the duplicate entries as a contra liability, effectively masking the issue without addressing the underlying data integrity problem in Payables. Option C. Initiate a detailed investigation into the invoice entry process, including system configurations, user actions, and any potential integration issues, to identify and rectify the root cause of the duplicate entries and implement preventative measures. Option D. Escalate the issue to the IT department for a system-wide patch without further internal investigation, assuming a widespread technical glitch. The correct answer is C. Initiate a detailed investigation into the invoice entry process, including system configurations, user actions, and any potential integration issues, to identify and rectify the root cause of the duplicate entries and implement preventative measures. Explanation. The monitoring system demonstrates a recurring pattern of duplicate invoice entries for the same vendor and invoice number within Oracle EBS R12 General Ledger and Payables. This scenario is professionally challenging because it directly impacts the accuracy and integrity of financial reporting, potentially leading to misstated liabilities, incorrect cash flow projections, and even fraudulent payments. The core issue lies in the potential for overpayment and the difficulty in reconciling accounts payable. The correct approach involves immediately investigating the root cause of the duplicate entries. This requires a systematic review of the invoice entry process, including user access controls, data validation rules, and any custom integrations that might be introducing duplicate data. Identifying and rectifying the source of the error, whether it's a user error, a system configuration issue, or a faulty integration, is paramount. Implementing preventative measures, such as enhanced duplicate checking mechanisms within Oracle EBS or process improvements, is also crucial. This approach represents best professional practice because it prioritizes financial accuracy, compliance with internal controls, and the safeguarding of company assets. It aligns with the fundamental principles of accounting and auditing, which demand reliable financial data. An incorrect approach would be to simply delete the duplicate entries without understanding the cause. This fails to address the underlying problem, leaving the system vulnerable to future occurrences. It also bypasses proper audit trails and may violate internal control procedures designed to prevent and detect errors. Another incorrect approach is to ignore the alerts, assuming they are false positives. This demonstrates a disregard for potential financial irregularities and a failure to uphold professional responsibility. It can lead to significant financial losses and reputational damage. A third incorrect approach is to only correct the entries in the general ledger without investigating the payables module. This is insufficient as the error likely originates in payables and needs to be resolved at its source to prevent recurrence and ensure accurate subledger to general ledger reconciliation. Professionals should employ a structured decision-making framework when encountering such issues. This involves 1. Recognizing and acknowledging the alert or anomaly. 2. Investigating the root cause thoroughly, gathering all relevant data. 3. Evaluating potential solutions based on their effectiveness in resolving the immediate issue and preventing future occurrences. 4. Implementing the chosen solution with proper documentation and change control. 5. Monitoring the system to ensure the solution is effective and no new issues arise. Question 19. Investigation of a proposed journal entry in Oracle EBS R12 General Ledger by a junior accountant reveals that the entry, requested by their direct manager, appears to reclassify expenses in a manner that might obscure the true nature of operational costs to meet a short-term budget target. The manager has emphasized the urgency and stated that it's a standard practice to smooth out expenses for reporting purposes. The junior accountant is concerned that this action may violate accounting principles and internal control policies. What is the most appropriate course of action for the junior accountant? Option A. Attempt to find a creative accounting justification for the journal entry without consulting any policies or senior personnel. Option B. Ignore the manager's request and proceed with standard expense recognition without any communication, assuming the manager will realize the error. Option C. Escalate the concern to the accounting manager or internal audit department, clearly explaining the perceived violation of accounting principles and internal controls, and seek guidance. Option D. Process the journal entry as requested by the manager to meet the reporting deadline and avoid conflict. The correct answer is D. Process the journal entry as requested by the manager to meet the reporting deadline and avoid conflict. Explanation. Scenario analysis. This scenario presents a professional challenge due to the potential conflict between a manager's directive and established accounting principles and internal controls within Oracle EBS R12 General Ledger. The pressure to meet reporting deadlines, coupled with a superior's instruction to manipulate data, creates an ethical dilemma. The core challenge lies in upholding professional integrity and regulatory compliance when faced with a direct request that appears to violate these principles. Careful judgment is required to navigate this situation without compromising ethical standards or the accuracy of financial reporting. Correct approach analysis. The correct approach involves escalating the issue through the appropriate channels within the organization, such as the accounting manager or internal audit department, while clearly articulating the concerns regarding the proposed journal entry's compliance with generally accepted accounting principles, GAAP, and internal controls. This upholds professional integrity by prioritizing accurate financial reporting and adherence to established procedures over a potentially unethical directive. It aligns with the fundamental ethical principles of objectivity and professional competence expected of accounting professionals. By seeking guidance and clarification from higher authority or designated compliance functions, the individual demonstrates due diligence and a commitment to ethical conduct. Incorrect approach is analysis. One incorrect approach is to immediately process the journal entry as instructed. This represents a significant ethical and regulatory failure. It bypasses established internal controls designed to ensure the accuracy and validity of financial data. Furthermore, it could lead to materially misstated financial statements, violating GAAP and potentially exposing the company to regulatory penalties. This action demonstrates a lack of professional skepticism and a failure to uphold the duty of care. Another incorrect approach is to ignore the manager's request and proceed with standard procedures without any communication. While this avoids directly complying with a questionable instruction, it fails to address the underlying issue and could create friction or misunderstandings within the team. It also misses an opportunity to educate the manager on accounting principles and controls, potentially preventing future similar requests. Ethically, it can be seen as a passive approach that doesn't actively safeguard the integrity of financial reporting. Third incorrect approach is to attempt to justify the journal entry with weak or fabricated explanations without consulting established accounting policies or seeking expert advice. This is a form of professional dishonesty. It attempts to rationalize a potentially improper accounting treatment, undermining the principles of transparency and accuracy. It also fails to leverage the expertise available within the organization to resolve accounting discrepancies appropriately. Professional reasoning. Professionals facing such a dilemma should follow a structured decision-making process. First, they must clearly understand the accounting principles and internal controls relevant to the situation. Second, they should assess the potential impact of the proposed action on financial reporting accuracy and regulatory compliance. Third, they should communicate their concerns clearly and professionally to their immediate supervisor, explaining the basis for their reservations. If the supervisor insists on the questionable action, the professional should escalate the matter to a higher authority or a designated compliance function within the organization, such as the accounting manager, internal audit, or legal department. Maintaining documentation of all communications and actions taken is crucial. This process ensures that ethical considerations and regulatory requirements are prioritized, protecting both the individual and the organization. Question 20. Regulatory review indicates that a significant expenditure has been incurred for a new piece of specialized equipment that will be used in production for the next 5 years. The expenditure was processed through Oracle EBS R12 Payables. The accounting team is debating whether to expense the full amount in the current period or capitalize it as a fixed asset. Which of the following approaches best aligns with fundamental accounting principles and the capabilities of Oracle EBS R12 for this scenario? Option A. Leave the expenditure in a suspense account within Oracle EBS R12 until a final decision can be made to avoid immediate impact on financial statements. Option B. Capitalize the expenditure solely because of its substantial monetary value, regardless of its impact on future economic benefits. Option C. Capitalize the expenditure as a fixed asset in Oracle EBS R12, recognizing depreciation over its estimated useful life as it provides future economic benefit. Option D. Expense the entire amount in the current period through Oracle EBS R12 Payables, as it was a disbursement process through that module. The correct answer is C. Capitalize the expenditure as a fixed asset in Oracle EBS R12, recognizing depreciation over its estimated useful life as it provides future economic benefit. Explanation. Scenario analysis. This scenario presents a common challenge in financial reporting, where a company needs to determine the appropriate accounting treatment for a significant expenditure. The difficulty lies in distinguishing between an expense that provides immediate benefit and a capital expenditure that provides future economic benefit, impacting the company's financial statements and tax obligations. Misclassification can lead to material misstatements, affecting investor confidence and regulatory compliance. The pressure to manage reported profits and cash flow can also influence decision-making, making an objective, rule-based approach critical. Correct approach analysis. The correct approach involves a thorough analysis of the expenditure against the Oracle EBS R12 General Ledger and Payables functionalities, specifically adhering to the principles of capitalization versus expensing as defined by relevant accounting standards applicable within the Oracle EBS R12 context. This means evaluating whether the expenditure creates a new asset, enhances an existing asset's useful life or capacity, or is merely for maintenance and repair. In Oracle EBS R12, this often translates to how the expenditure is coded within the system, e.g., as a fixed asset addition versus a standard expense account, and the subsequent impact on depreciation schedules or immediate expense recognition. Adhering to these established accounting principles ensures financial statements accurately reflect the company's economic position and performance, promoting transparency and compliance with financial reporting regulations. Incorrect approaches analysis. One incorrect approach is to expense the entire amount simply because it was paid through the Payables module without considering its nature. This fails to recognize that the Payables module is a disbursement tool, and the accounting treatment is determined by the underlying nature of the transaction, not the payment method. This can lead to understating assets and overstating expenses, distorting profitability and financial ratios. Another incorrect approach is to capitalize the expenditure solely based on its large monetary value. While significant expenditures are often candidates for capitalization, the decision must be based on whether it meets the criteria for an asset, future economic benefit, rather than just its size. This approach ignores the fundamental accounting principle of matching expenses with revenues and can lead to overstating assets and understating expenses in the period the expenditure is incurred. A third incorrect approach is to defer the decision and leave the expenditure in a suspense account indefinitely. This is a failure of proper accounting practice and regulatory compliance. All expenditures must be assigned to an appropriate account in the general ledger. Leaving items in suspense creates an incomplete and inaccurate financial picture and can mask potential errors or fraudulent activities. Professional reasoning. Professionals should employ a structured decision-making framework. First, clearly identify the nature of the expenditure. Second, consult the relevant accounting policies and standards that govern capitalization versus expensing. Third, map these principles to the functionalities and account structures within Oracle EBS R12. Fourth, document the rationale for the chosen accounting treatment, ensuring it is auditable. Finally, review the decision with a senior accountant or auditor if there is any ambiguity. This systematic approach ensures compliance, accuracy, and professional integrity.